Hello and welcome to another weekly update and review. Today is Saturday, August the 3rd, and we're going to take a look at the wild ride week that we had last week, just finishing yesterday. As you know, probably markets pulled down not as much as you would think looking at the VIX, because it was the VIX that spiked. You could almost say unreasonably high, even though, who is to say what's reasonable or not, but it was a huge spike in VIX, and that's what hurt many of the naked premium, and any premium sellers, us included, and we did hurt a bit. We're going to go over that into detail as I share everything, good, bad, and the ugly. And last week for us was pretty ugly, and the best thing we can do from that is learn some lessons, adjust the plan if we see fit, which I do have some ideas, and we're going to go over that, what I think is mostly to be blamed, and obviously we are ultimately mostly to be blamed. And we can certainly improve for the next time we face similar situation, because now we have a first-hand experience and as to what can happen when the wall spikes and our positions get challenged. Although we hurt pretty decently, looking around, and not everybody shares, the bad stuff. So some people that I follow on YouTube don't really go into detail as to how they fared last week. But the ones they did, the ones that I respect, I feel we're somewhere in between, not the worst, not the best, somewhere in between. So, but everybody got hurt, generally speaking. I'm sure there's some people out there that were hedged properly and might not have hurt as much, but I think for the most part, everybody did. So today we're going to go over our performance. Let's jump right into the screen here and start with the usual performance over the week. As you can see right here, we are down 14% and a change week over week. Market is down only 2%. It was the VIX that brought all the carnage on us, and you can see here on the sheet, well, we're basically down to a little bit under where we started the year on a net lick. On the realized, we're basically right at the beginning of the year. So it's going to take us some time to recoup that back, but this is part of the of trading, and we should do our best to improve. But as I always like to mention, we need to be ready for these pullbacks. They're going to come no matter what we do. The pullbacks are going to come, and we need to be ready. So we'll go over our positions and then take a look at what I think caused most trouble. Here, this is the page where we record our UOTS trades, and everything in red is a stop loss. It was past our stop loss point, as you can see right here from this column right here, where you can see that it's 250, 296, 305, 290, 260, everything well over and above our target of 200%. This is a problem because it messes up the long-term projections. So that's something we need to do about it. The problem was I couldn't react in time. I was at work when the market first opened, but even if I was, there was significant drop, volatility spike at the beginning, early at the beginning, and I might not be able to close it anywhere near 200%. But this is what contributes to outsized losses. And if you take a look at the main page, I recorded this last night. We were down to 58,000, and then our buying power usage is fine. As a matter of fact, we can take a look here. I think it went down after I recorded. Yeah, it went down to 25%, 22%, because I recorded these metrics before I closed off some trades. So we're in a different position now than when this was recorded. But we don't know what the Monday is going to bring. So the worst is not over yet. We still have plenty of open positions. Right here, everything that's here in blue and down here, these are all open positions that are still potentially facing stop losses. However, at this point, we should see some better reaction from the put debit spreads that are now partially in the money, as you can see right here. And then also on this page, also we have a little bit in the money. We still have a couple of zebras that we couldn't actually close. The liquidity was bad. And I was trying to close them as a single trade, both longs and shorts at the same time, since tastytrade rather recently, unable to the option to close this as a single trade. Last time I had this, I had to close them separately, and I didn't have that many issues, and I did close them. So this time, trying to close them all together caused some issues. And on Monday, if we decide to close them and it doesn't work, I'll go back to just separating the longs from shorts and closing it that way. So that should work. And depending on the market movement, there might be a little bit of money that we can scoop. And then, as you can see right here, there's a little bit of profits in these. So depending on what happens on Monday, if the market continues to go down, even though by any measure this is not a huge move from the market movement point of view, it is the huge spike in VIX that happened right here that caused all the trouble. And this is another reason why we may need to pay a little bit more attention to this Vega number, portfolio Vega, and keep it under certain measure as related to our NetLick. So with all that said, let me just take a look here and talk about this a little bit. First, I want to remind everyone, when I created this logo for the steady income trading, I purposely put this here to remember that it's not a smooth ride. It can't be a smooth ride. There will be setbacks, and this is what the red bar here represents. Our goal is to, over time, continue to go to the up and right, but there will be occasional setbacks. One of them we're just facing now. And then I did some thinking, analyzing of the positions and what could be improved and what was the main culprit. And I narrowed it down to three main things. There could be more, but these are the three big things that I'll be addressing in the next, fine tuning of the strategy. We'll wait obviously for the whole, for all this to play out next week, but then I'll be probably doing some tweaks and changes to the strategy. And number one, too big, over leveraged. Well, it's simply, let's go back here. Even though I do have a couple of different ways to measure the exposure, notional divided by NetLick, and then that also can be seen here in the units at risk measurement, which is another one that was, in the low three, well, it's better to take a look here, and because that number is NetLick divided by this units at risk gives you the funds per unit of risk. And as we can see, we were around 20,000, but then recently I went down to almost 15,000 per unit, which seems to be too much, and we'll have to include that as well as a measure of maintaining the portfolio metrics. So that's one. That's on too big, over leverage, however you want to call it. One way or the other, we traded too big. There are different ways we can approach that. I'm going to try and figure out how to implement that as a part of the plan to make sure that we don't go like that next time. The second big thing is couldn't exit in time. So as I showed you right here, this is a big problem because I couldn't honor my stops, and all of the math is based on the 200% exit, maybe to 210, 220 or something. But this is significantly, if you get to 300 or 290, that's significantly different from the planned. So that's not easy to avoid. It's simply not. I mean, unless you're glued to the monitor, and even if you are glued to the monitor all the time, overnight moves can cause an early spike in the morning that you just don't have time to react and exit in time. So that's not easily solvable by simply monitoring. Plus, I have a full-time job and I don't plan to monitor. I want to have hands-off for the most part approach, like I've always done, trade a little bit and then go do other things. So I have to rethink my original plan. And for those of you who've been with me for a long time, you know that I used to have in this corner right here, I used to have stop loss of 250. And then I simplified it and made it a little bit more conservative to go down to 200, even though 250 kind of the numbers worked slightly better, but you have to face a little bit higher losses when you do stop out. But I'm rethinking this again now, because had I had a stop loss of 250 or even 300, then I would plan properly for that. You see, I'm doing all of these projected losses with the full book wipe loss as a percentage of the net lick. This is based on 200 stop loss, but that obviously, if my plan stop loss was 250 or 300, this number would be bigger, and it would slow me down in putting on the new trades. So even when we stop out, then we stop out at a amount that's closer to what we projected it to be. Now, another benefit of doing 250 or 300 would be that we would stop out less often, as some of the trades would recover from reaching 250 or 300 and then recover back, so long as it was planned. We don't want to do this just in order to hope market will reverse. That's a secondary benefit. But another very important thing that doesn't come into mind right away when you think about stop loss is that having a larger stop loss allows for the market to work for a longer time, which then allows PDSs to kick in, because PDSs were a big disappointment this time. And then this is number three. PDSs didn't bring enough help. So they're just too far out of the money, too far away in time, and they just didn't bring. Let's take a look. If you take a look right here, even though there's a little bit of profit here, 90 bucks, that's nothing. That's not enough to show any kind of resistance to these volatility moves or market pullbacks. Now, granted, the market didn't pull back too strong, so it was just volatility. So had the market gone down a little bit further, like you would associate with the VIX at almost 30, VIX jumped around 60% from somewhere from the high 18 to around 30%, which is around 60%, give or take, which is a huge jump. This is not something we would expect to happen all the time, but it will happen. It will happen again, and it's something that happens. I don't know, every couple of years or something. We have to be ready for that. But had these put debit spreads been closer to the money and had a higher gamma, we would probably be able to close some of them already yesterday for a little bit more profit, because we don't want to close them for just a small profit. But they might come into play next week. We'll see. That's so the put debit spreads just didn't do what we wanted them to do, and why we have them there. Now, they're not a hedge. They're not a hedge. They're just helping a little bit, and that's their goal. The purpose is to help us a little bit in a strong pullback, and then to bring some grind down income in a grind down markets. But they just didn't perform as well as we would have hoped. So we're going to have to rethink them. And obviously, the way to approach that would be to talk about the duration, the DTE, the initial DTE, and the width and the deltas. And basically, we just want to make them stronger, more reactive to the market. Now, you don't want to overdo that, because then they would be expiring too soon. You don't want to go too short PD in a DTE, because then they would be expiring too soon, and you would lose all of them as you go along. So we need to find a balance. But the current setup is obviously not optimal for what we are trying to do, because I am ready to have the drawbacks of roughly 20%, which if I'm targeting 20% CAGR, I'm okay with a 20% pullback in my net lick. But that's something that should happen in an extreme case, not in this last week's move. We didn't pull back 20%, but still, it shouldn't be this strong. So I do need to emphasize that there will be pullbacks, and I'm ready for them. But for a market move of a couple of percent, and this amount of VIX, we would hope to have a little bit less of a negative impact. But that's it. Nothing. The most important thing, to take the lessons learned, redraw plan, but not just redraw it for purposes of redrawing it. We really need to think about the specific things that can be improved upon while still keeping the same. Because overall, the strategy performed okay if you were able to get out at 200%. Maybe some of you who were at the desk right at the opening could have. I don't know. I haven't seen the market for the first couple of hours really, so I don't know. But yeah, that's it. Make sure you leave some comments, and if you have any ideas or questions. And then if you find this video useful, make sure you like it, consider subscribe it. And as always, you can join our free Discord. Link is in the description below, and we can go into more details in the Discord. Have a fantastic rest of the weekend, and I will see you Monday. Bye.